What's up, guys? Welcome to another Market Radar podcast. We had another slow week for equities and bonds. Quite a bit of chop ever since our system flipped to stagflation. So there it is. We've been in stag for a while now, and it's doing exactly what we expected it to do. NASDAQ closing the week, 59 basis points, slight rise after CPI, but really nothing crazy going on.
Okay, so let's go over bonds here. So bonds closed down 19 basis points on the week. They did move higher following CPI here with the white line. So again, bonds higher after CPI, which is to be expected as they fell into the print. There's still bearish trend though. So all the guys that are trying to long the dip in bonds, the time is not here just yet. But let's go over what's going to happen next week in the economic calendar.
Next week, we've got Tuesday, Wednesday, and Friday as the main days. We have retail sales, industrial production on Tuesday. Wednesday, we've got housing starts and permits. Thursday, we have jobless claims. Obviously, we're always monitoring that. That's what the Fed is watching. That's what we're watching. And Friday, we have Powell at a conference talking with Bernanke.
Okay, so let's go over what the main topic is of this week, and that's going to be, is inflation over? Meaning, is inflation a problem of the past? And the answer to that is no. Inflation isn't just done. We've been very vocal about this the past few weeks, past few months, I should say, that it's very likely, it was very likely, and we were right, that inflation would come down rather quickly to the fives. But now going lower than 5 is going to be a bit tricky. Inflation is just not going to go down to 1%, at least in our opinion. And I think we're going to be right on that, especially given what break evens are signaling. We're going to go over that further in the podcast, but let's just go over jobless claims. So they came in this week at the highest print since Q4 of 2021. They're slowly breaking out now. Again, they're taking out the peak for the prior year, and they're starting to show signs that I should say the claims are starting to show signs that the Fed policy is taking root in the market, in the economy more so, right? Because you're starting to see jobless claims pick up again, an effect of higher and more restrictive Fed policy. So this is the first print in CPI that we saw this week, in the last week when CPI came out, that breached the 5% mark since 2021, the April print in 2021. Now, inflation is now in the position where the Fed is literally on top of it from a policy perspective, right? Because now the federal funds rate is at 5 and inflation is sub 5%. Like I said earlier, it's highly likely that inflation hits this roadblock in the 5% mark. Number one being unemployment hasn't really picked up enough yet to really merit a lower inflation rate. Again, you can argue all you want about the Phillips curve, but historically, as you go above 5%, in inflation, you start to see that there is a stronger and more effective correlation to that Phillips curve. It's not perfect, but again, it does make sense to the degree that if more people are unemployed, there is less demand for goods. It just gets it gets very skewed when we go into that sub 2% unemployment, sub 2% inflation range, where the economy is almost like a dishwasher. Everything's getting spun around. It's very hard to track things in that range, and there's a lot more noise and less correlation. But back to inflation, we saw inflation peak in July of 2022 at 9.1%, and now we're at 4.9. Rather steep decline, and forecasting all of this has been the 5-year break-even inflation rate. We went over this last week. We will continue to go over this. And the importance behind this is it signaled exactly what inflation was going to do before it did it, right? Let's take a look at the break-evens, which are the orange line. Now, what the break-evens are, simply put, they're the market-priced expectations of inflation over the next 5 years. Simple, right? The 5-year break-evens bottomed in September, and they haven't really gone lower since. And typically, they lead inflationary numbers to the up and downside head of the curve, meaning break-evens will bottom and break-evens will top before inflation bottom and tops, that being the CPI year-over-year index.
So what's the reason break-evens are really getting hung up here, especially after seeing jobless claims numbers come in higher? What are they waiting for? What is the market thinking? Why does it think that inflation really is kind of still possibly an issue?
Well, you haven't had remember the Fed policy of what they've done in terms of the rate of change of how they've done it. Again, from last year, we started hiking in January of 2022. It's now May of 2023. So basically, you have almost 18 months. 18 months since they started, but we've only gotten to 5% in the last meeting. So there's a lot of lag built up here. This is one of the fastest rate hiking cycles in a very long time. And in terms of a rate of change, in terms of where they've gone percentage wise, this is the fastest rate hiking cycle ever, right? At least going back to 1950. We'll put it like that. This is the fastest since the 1950s. And there's going to be a bleed of effects here from the Fed policy actions into the market. And what you're seeing is, again, break evens peaking in March of 2022. CPI didn't peak till July. Number one, the primary reason behind this is CPI is a lagging indicator. Break evens are market price, meaning they trade every day. So CPI comes out once a month. Break evens are more fluid, more liquid. They pick up information a lot better, obviously, than CPI, because CPI is a measurement of certain things, where certain fixed items, right? Where break evens are the differential component between between fixed and between nominal and inflation protected securities. That's the spread of rates between those two bonds, meaning it's all market price. There's not just one factor, or call it a basket of factors that these break evens are priced off of. It's the entire market, what the entire market thinks. So it's more dynamic, more rich in information than just the CPI. Now, in terms of why they haven't broken lower, a lot of things. Oil hasn't really dove lower, right? It's gone down. It's been in a bearish trend, I think since June or July of 2022. So it's been bearish for a while now, but it hasn't really broken down in terms of a steady decline. It's more so chop. Another issue being, look at what break evens are telling you. Break evens are at the 2% range. So pretty much they're pinned around 2.11% for the next 5 years. The anticipated average inflation rate over the next 5 years is 2.11%. CPI is still at 4.9%. So CPI is still well above the break evens. It's going to be above the break evens though, because remember, that's how this works. This is a year over year change. The break even is an average change over the next 5 years. So it's going to be lower because you're accounting for 5 years, not just one. But in terms of where the break evens are going, they are pinned near the lows, but they're not breaking down yet. Now, the reasons why they haven't broken down, I can't really tell you. But what I can tell you is the market's thinking inflation might be a little bit stickier for a little bit longer. And that's exactly what we've been saying in terms of inflation going under 5% and really falling apart, right? Because we said that break evens aren't signaling a huge decline in inflation, but neither are they signaling a huge rebound. And sure enough, we got a CPI print that was 10 basis points under the prior print. It's one of the slowest, if not the slowest decline in inflation that we've seen since the start, since the peak. Primarily, again, being that the inflation metrics have to wear off in different ways, right? We have all these sub-inflation metrics. Everyone likes to look at core, all these sub things. They're all lagging. Inflation by its composition is a lagging indicator. It's reported a month late. It's using things that haven't hit them, that are behind in data. It's just the components are lagged itself. It's a lagging indicator. So yes, inflation is important in terms of the rate of change. It's what our system uses. It's our bread and butter. It's inflation and growth, the rate of change of each, that makes our system, along with more underlying market components. Now, break evens, they are very important because they are active. It's like a real-time inflation indicator. So as you can see, once break even started lifting up in 2020, you knew that this start with the idea of a deflationary or perpetual deflationary event was pretty much over within a few months. CPI took a while to get back above 1%. Back above 2%. Break evens were at 2% rather quickly, but in terms of 1%, I shouldn't use percentage. I should talk about their rebounds from their peak. Break evens rebounded well before inflation did. Inflation took almost a year and a half to rebound.
Right.
Where break evens did in less than almost 10 months.
So right now we have break evens at 2%, which is the Fed's target rate. If they drop lower down to 1% or even 0, isn't that signaling that we're actually going to be getting quite a hefty deflationary period?
That would be the deflationary period, right? If break-evens, if on a 5-year forward on break-evens, if they go to zero, that's extremely deflationary,
Right.
right?
So we actually can't really, we shouldn't be expecting much of a drop in 5-year break evens.
No, but I think this chart might be confusing to some listeners who are new to the space. They don't understand so much what break-evens are. So let's go back to 2018, right? This right here was a deflationary environment. Break-evens went from 2 to 1.28, right? I'm not saying that we're going to measure moves or none of that nonsense. What I'm saying is 5-year break-evens go from 2 to 1.5. You're probably looking at CPI back under 3% at that point, right? Like you just gotta kind of wing it a little bit in terms of you can't exactly extrapolate. But what I'm trying to imply to you is for inflation to break lower from here, right? You see how it gets hung up here in the prior print. For inflation to break lower, we're going to need break evens lower than this. If break evens sit here at 2%, what that's going to tell you is the market's anticipating there to be an issue here. Why isn't inflation not going? This is why are inflation expectations not going lower? Exactly what the market is telling you right here. They're not going lower. There seems to be an issue with inflation, right? So some of the things that we can watch, again, we'll add oil, right? Let's take a look at oil quickly. Here's oil. You see oil is down off the peak, but just like these inflation expectations, oil is not down much. So if we start to see oil roll over and some other inflationary factors roll over, then it's likely that we're going to see break evens roll with it. And to be honest, break evens do a real good job at even front running oil. So it's very interesting to see how all these things work in terms of what the market's able to price. And the market's not always going to be right. The market's also going to be right in terms of pricing more than it is wrong, because if that was the case, then consensus would be right all the time. And that just doesn't happen, right? So in terms of where inflation is going to go, we're watching break evens like a hawk. Right now, as we've been saying, we've been very clear about this. It's easy to bring inflation from 9 to 5, but from 5 to 2, that's the hard stretch that everyone's going to have to endure. Now, let's play the flip side here. By the next CPI or the next two CPI prints, what happens if break evens fall a lot lower? And maybe there is this dramatic recession, right? Well, as soon as you start seeing, trust me when I tell you this, the Fed is watching the break even rates. They're watching this. When they talk about inflation expectations, that's what they're talking about. May not be specifically the 5-year, but they're watching break evens. Now, if break evens start falling down aggressively, the first thing that's going to happen is the Fed is going to sit there and say, shoot, did we over tighten? Oh, shoot. They're going to look at each other and be like, did we screw this up? And that's when the debate starts, the internal debates of, oh, do we cut? Do we cut rates now, or do we do we start easing policy, or man, maybe we can hold through it? And you get into this dilemma where like you could do it now, but it might be too early. And if you do it and it's too early, you screw everything up. The market will start ripping inflation expectations higher, thinking that okay, we actually haven't cured inflation, and the Fed's going to start easing again, and this whole cycle is that 1980s era repeat. And if we start seeing break evens go lower, that's what the Fed is going to be thinking, because their intentions are going to be to hold inflation for as high, hold Fed policy as high and long as possible to kill that inflation rate. So if they can't, if inflation starts falling aggressively and unemployment hasn't picked up, the first thing they're going to say is, you might say, oh, they did the soft landing. The Fed doesn't believe in a soft landing because the soft landing doesn't exist. Okay, it's some hopium idea that we're going to get this perfect storm that's going to settle the eye. We're going to land up right in the eye of the storm. We're going to be undamaged and everything's going to go on as usual. That's like some perma mentality nonsense. In reality, there's no such thing as a soft landing. We call it the impossible soft landing because it's impossible. But most people will think it's going to happen, or do think it's going to happen. And the key to that is, in terms of what's really going to happen, it's the hard landing is going to happen when everyone believes the hard landing is no longer possible. So the long story short, the soft landing continues until all faith in the hard landing is lost. Now, the Fed knows this too. They're not stupid. So when they start to see inflation expectations dive, they're going to look at unemployment. They're going to think, okay, the hard landing is starting to form. And if unemployment is not picking up, they have a real dilemma on their hands now, right? Because now if they start reducing the Fed policy rate, and the labor market isn't expanded enough to where it's somewhat broken or cracked, right? The jobless claims numbers we saw were good to see in terms of like how I don't want to say good like people are unemployed, but they're good to see that the Fed policy is working to the point where they don't need to be that more restrictive than what they are. So obviously things are going towards or going in plan of what the Fed has laid out. But it's still not extraordinary here. This is not, oh my God, like we're in recession. This is not crazy.
Right. Well, now they're just kind of in like this waiting game situation to really see the effects, the delayed effects of what they've done over the past year actually happen.
Right. Now, the problem with this is if inflation, like I just said, which I don't think we're going to see it, but again, our system is based on a quant approach, meaning what I think is cool, but like if the system says something, my thoughts go out the window. But over the last year and a half, my thoughts, you guys have come and tuned in because my thoughts have panned out rather well. But in terms of actually taking action, it's whatever the system says. If the system says jump, you just say how fucking high. You don't question it. You just go full send it. There's no like, oh yeah, but this time is different. No, it's not. It's simple. Once you start doing that,
it's never different. Right. You slowly start to realize it might seem, oh, you know, every time the system says something, oh, it's scary. You know, it's definitely against consensus because it's always going to be against consensus, and you just gotta get the balls to jump.
Exactly, and it's crazy because at the end of the day, what's going to happen here is going to dictate the next leg of this scenario, right? So if inflation starts breaking down, or inflation expectations, start breaking lower, what's going to happen is the Fed, like I said, is they're going to be faced with this dilemma. They're going to say, well, shoot, if we start cutting rates right now and unemployment is actually mendable at these levels, you're going to have that demand come right back in. And that's going to be an issue. So it's a very tricky situation. We do think that this unemployment, the CPI rate of change in year-over-year basis under 5%, we might start chopping up around here. I do think, unless again some deflationary event comes out of the corner and starts picking up to the downside, by then most likely our system will be in deflation. Now, let's talk about deflation because that's everyone's like, oh, this is deflation, growth is down, all this other stuff. But in reality, they don't understand that the rate of change of growth actually isn't as bad as what a lot of people want to make it out to be. It's actually quite well, to be honest with you, at the moment, in terms of holding on in positive territory, and inflation is slowly coming down. So you have this almost like expansionary type of vibe in the markets, right? Equities are up, bonds are slowly grinding up, volatility is down, but it's not really expansion. What you're looking at is a window within a bigger picture. You're looking at a window within, and if you step back, you're going to see the bigger picture, that being stagflation, where when markets chop, a lot of people can build false narratives. It's very easy to build a false narrative in a sideways market. You know, well, let's just take NQ, right? We'll take DDAP off this and you just look at this. You can build a 10 different narratives by just looking at this one chart of what's going to happen next. It's very easy because there's nothing's happening. So you can say, oh, well, we can take out here, we can go higher, we can take out this high, we can go higher, we can take out this low, we can go lower, we can chop. You can build a million different narratives. Not that it matters. At the end of the day, that's why we have our indicator. It gives us a simple and concise way to view markets. Bullish, bearish, neutral trends. That's all you need to know. But back to what's going on with inflation, with this deflationary environment. For this deflationary environment to really take hold and start and basically lift us out of stagflation. For those that don't know, stagflation tends to be a precursor to deflationary regime. So you need that stagflationary regime to segue you into that deflationary regime, where that's where all the bond money is made, the long bond money. That's where all the long gold money is really made. Long gold is useless outside of deflation, pretty much, or in stagflation as well. But you need the right regime, and I'm going to go over that right now. What that issue, why we don't have that right regime, and that's due to break-even rates, that's due to real yields, which are the nominal rate, the 10-year that you see on TV, minus the break-even inflation rate, which this is the 5-year. When we look at 10-year, we're going to take the 10-year nominal minus the 10-year break even. We get the real yield. Real yield's positive 1.29. Bonds and gold, have a negative correlation to real yields, meaning when real yields go up, bonds and gold go down. Vice versa. When real yields go down, bonds and gold go up. This is a known and proven correlation. In terms of real yields going up right now, you have one major factor driving real yields higher, and that is the debt ceiling in this whole government default situation. Now, why? Why would real yields go up? Remember what they are. They're a nominal minus break even. So it's the nominal that trades on the open market, and it's the break even, which is the anticipated inflation rate over the next 10 years. Now, as you take a look here at the 5-year inflation rate, it's rather low in terms of where it has been, and it's pinned to the lows. So if we take a look at the 10-year, at the 10-year expected inflation rate, the break-even inflation rate, also as well on the lows. Why are real yields going up then? What's going on? Why are nominal rates going up and break-evens are pinned to their lows and or going lower? It's because there's an issue now with a potential deadline that won't be met in terms of extending the debt limit, the debt ceiling, and we're going to hit our debt limit. And there is a possible credit downgrade, meaning treasuries are going to get re-rated at a lower credit rate, risk rate in the credit markets. What that does is it automatically guarantees a higher nominal rate of return, meaning just like think about it like a high yield junk bond, right? Think about the US Treasury. We're going to use simple facts here, yielding 1% right now. We're going to talk just basic treasury yielding 1%. A high yield bond cannot yield 1%. It has inherently more risk because it's lower. It has a lower credit rating, so it's going to demand a higher yield. And this is real basic for those that don't know the bond space too well. But now if you have, call it US Treasuries trading a AAA rating, if they get downgraded, whatever that downgrade may be, they're no longer of that same statute of credit rating. So therefore, they deserve the world, I should say, anyone that buys treasuries will want a higher yield. Whatever credit rating that downgrade is and whatever higher yield, that's to be determined by the markets. But the reason nominals aren't breaking down is because if the market is not going to just go one way and say, oh yeah, deflation's coming, a recession's coming, nobody cares about the debt limit. That's not what's going to happen here. The markets are dynamic. They're very fluid. So if this debt limit does come into it, which seems like every day now we're getting closer and closer to it, we all know that the United States is not going to default, but we've seen credit re-ratings on treasuries before. But we know that the default is kind of like a doomsdayer thing. That's not really what's going to happen. It's more likely there's going to be a credit re-rating. That's really where the market is going. That's why you're seeing nominals trade higher. If we just take a look at the 10-year.
Well, also it's something that people seem to always forget is everyone thinks it's binary, like, oh,
right,
the US is going to default, or the US always not, if they're not going to default. It's never binary. The market is always going to price in whatever percent chance of something occurring is. So even if there is a 5% chance of a credit downgrade, you're going to see that priced into the market, and it's going to price it accordingly.
Of course. And that's what we're seeing, in my opinion, here is the reason there's this general hesitation to chase bonds. Remember, bonds are literally, US treasuries are like literally the world's safest asset outside of maybe gold, right? Like in terms of like, actually from a risk adjusted return, like you're guaranteed something on treasuries basically, which you aren't on gold, right? You're guaranteed the coupon paid by the US government, which is considered one of the safest central banks in the world. One of the safest governments, and therefore the Fed is considered one of the safest central banks in the world. For the US to default on their debt, you're talking about giving BRICS power. Like this whole BRICS thing that's been going around the internet, the de-dollarization of the world, that picks up steam if the United States defaults, and that picks up steam very quickly. And the United States, no matter what political party, they're going to come to an agreement here. Someone with some nuts is going to come into some conversation that we don't know about, backdoor conversation, and say, listen, guys, I don't care what your opinions are. This needs to get done, or these things are going to happen, these terrible things. And it's going to be dumbed down to them because, unfortunately, politicians don't have an actual economic grasp of what happens when they make these stupid policy errors. And someone's going to tell them. And if they don't, well, then that's the US dollar is going to get slapped like you've never seen. But I doubt that, again, that's going to happen. The reason the US dollar has been such a powerhouse is because the United States is very good at weaponizing the dollar in this way. And this is the United States' strongest weapon. They like to say the military is. It's not. The military is number two. Number one is the dollar. You can do more damage to a country by cutting off their swap line than you can by sending over missiles, javelins, or even drone strikes. So the dollar is the best weapon the United States has. If you think they're going to just let some debt default like screw that up, that you're playing a fool's game. They're not. The problem is the drama that comes with this. It's the circus act, right? It's, oh, now what happens if you get a debt downgrade? Okay, this whole noise and all this nonsense is why people aren't really chasing treasuries, because neither would I. If you're talking about let's just say you had $100 million in the bank account, you want to buy long-term treasuries. Are you going to buy them now, or are you going to buy them when the debt ceiling is lifted and you know that the government's going to continue the facade, this whole thing that they've been doing? You raise the debt ceiling, you hit it, you raise it again. This is the game, and this game will continue. If someone says they're going, all spending cut proclamations do is just make you think that they're going to do the right thing, and then it just gets reverted. It's a bunch of bullshit. Unfortunately, that's our government. That's the world. We're all addicted to easy money, and we want to just ride the gravy train, and that eventually comes to an end at some point. But Japan's shown us that the margins of comfort are huge. U.S. has a long way to go before they're anywhere close to Japan. So that's why it's not really a big concern of us or of the markets right now. And the real concern is, go back to that $100 million. You got $100 million. Are you going to buy bonds today? Or are you going to wait until there's some more clarity and you don't get the credit re-rating? Because what happens if you get a credit re-rating? You could assume these bonds may move up 50 basis points from here on the long end, 100 basis points, right? Depending on this, again, depends on the credit re-rating. We don't know, but just for shits and giggles, it goes up 50 basis points. Now, why would you sit and endure some nonsense like that? Whereas we've been very clear on I think a debt ceiling is going to be bullish for a debt ceiling resolution is going to be bullish for bonds, bullish for stocks. Market Radar has been in the position for the last couple of months, or the last 4 months now, that the stock bond correlation will remain positive unless the recession we see is deep enough to break it. Meaning, if we do get a recession, which is what the bond market would need to send bonds higher, if we do get a recession and it's not deep enough in terms of the growth contraction, what you're going to end up having is stocks go up and bonds go up. So all the guys that are shorting their spoos to buy the bonds, they're about to get wrecked. And all the guys that are, long those black swan puts, about to get wrecked. But long story short, if the recession, they're going to get wrecked if the recession is not deep enough. If the recession is, they'll get saved. But the reason why the recession may not be deep enough is, depending on how inflation comes down, we've been very vocal about the rate of change. If inflation comes down really, really, really slowly, what's going to happen is it's going to prevent the Fed from reducing policy rates, which, from those that don't know, Fed policies lagged out, meaning what they did at the last meeting won't really show up in the market for 3 to 6 months. So until we start to see the market break down in terms of warranting Fed cuts, growth is going to get hit in the process. So the longer the Fed holds rates at 5%, the more or at this restrictive level where we're now above the rate of inflation, the growth section of the economy is going to start taking hits. It's going to happen. If inflation expectations don't come down quick enough, you're going to get that deep recession. But if they do come down quick enough now, if they come down in line with growth, with that decline in growth, it's going to be somewhat of a seesaw on the way down, nice and balanced. And there's not going to be much shock to the markets, because for the markets to go lower, again, ES, right, or NQ to break 2022 lows, you're going to need an expected recession that is worse than what the market was expecting a year ago. Meaning, for the market to break new lows and crash from here, you need to have something hit the markets in terms of growth expectations, inflation expectations, combined worse than what we saw 6 to 8 months ago. And that's just very unlikely at the moment, which is why we've been saying this entire time, stock bond correlation likely stays positive in the sense that bonds and stocks both go higher. But we cover all this every day in our daily reports. We have a Discord channel. We talk about everything real time. Go to our website, market-radar.com. Thank you so much, guys, for listening, and have a great week.